Welcome back to Investing Talk Podcast.
It's great to be back. We've got a really fascinating one today. We're looking at Bitmine Immersion technologies.
And before we get into the weeds, and trust me, we are going to get deep on this one. As usual, before we start, subscribe, like, and comment to this video to support the show.
It really does help.
It does. We appreciate every single one of you. So, Bitmine. The name implies, guys in a warehouse plugging in servers. Is that what this is? Just another crypto miner?
Well, that's exactly what they don't want you to think anymore, and that's really the hook here.
Okay.
If you look at the name, you see mining. But if you look at the balance sheet, you see something completely different. Bitmine has effectively pivoted. They're not just a mining company. They become a digital asset treasury vehicle.
A treasury vehicle. Okay, let's unpack that. That sounds like a lot of corporate buzzword soup to me.
It does.
It sounds like they're acting more like a holding company. Or maybe an ETF wrapper, not an industrial operator.
Precisely. Think less like a gold miner digging in the dirt, and more like Fort Knox holding the gold bars.
Right.
And the scale of this pivot is what we have to talk about first, because the numbers are frankly staggering. They're running this strategy they call the alchemy of 5%.
The alchemy of 5%? That sounds ominous. What does that actually mean?
It means their stated goal is to own 5% of the total circulating supply of Ethereum.
Hold on. 5% of the entire global supply of the second biggest cryptocurrency?
Yes.
That's massive. Is that even feasible? I mean, we're talking about a decentralized network. For one company to try and grab 5%, that sounds almost like a monopoly play.
It's a huge ambition, and the crazy part is they're actually getting there.
Real?
As of our data for today, Monday, February 2nd, 2026, they're already holding between 4.14 and 4.17 million ETH. That's roughly 3.45% of the total supply.
Wow.
We're talking about the largest fresh money buyer of Ethereum on the planet right now.
And fresh money, just to clarify, that means they're actively buying this now. This isn't some, early adopter who found an old hard drive.
Correct. They're sweeping the floor.
But I have to ask the so what question. I mean, besides bragging rights, what's the strategic value of holding 5%? Does it give them control or something?
It gives them gravity. In a proof-of-stake network like Ethereum, ownership equals influence. It equals governance.
Ah, okay.
As they get closer to that 5% threshold, they become a major force in the direction of the network. They're not just passengers anymore. They're grabbing the steering wheel.
Okay, so they're trying to corner the market to become a governance heavyweight. Let's dig into the fundamentals then, because whenever I hear treasury vehicle, I want to know what's actually in the vault.
Let's do it.
You mentioned the ETH count, but what's that worth in, cold, hard dollars?
Well, you combine their crypto holdings with their cash, and they are sitting on a war chest of roughly $14 to $14.2 billion.
$14 billion. That is a massive balance sheet. But just to play the skeptic here, because that's my job, how much of that is liquid cash versus, volatile crypto that could get cut in half tomorrow?
It's heavily weighted to crypto, obviously. That's the nature of the beast. But the cash position is surprisingly strong. They're sitting on roughly $915 to $988 million in pure cash.
Nearly $1 billion in dry powder.
Exactly. Just waiting to be deployed.
Right, and that cash is critical because when I looked at their earnings statement this morning, I saw something that would make a traditional investor run for the hills.
I know what you're going to say.
We have a company with $14 billion in assets, but their operational revenue, from actually selling stuff, is only about $7.19 million over the last year.
A stark contrast, isn't it?
It's more than a contrast. It's a complete disconnect. You have billions in the vault and pennies in the register. Now, granted, that revenue is up almost 80%, so the business is growing. But here's the number that scares people. The net loss. They posted a net loss of approximately $4.87 billion.
It looks terrifying on paper.
Terrifying is an understatement. If this were a grocery store and they lost $5 billion on $7 million in sales, they'd be bankrupt by lunchtime. How are they even keeping the lights on?
You have to look under the hood. That $4.87 billion loss, it's not operational burn.
Okay.
They aren't lighting cash on fire, paying for electricity or big CEO salaries. That loss is driven almost entirely by non-cash impairment and mark-to-market adjustments on their crypto.
Okay, non-cash impairment. We hear this a lot. Break that down for someone who isn't a CPA. Why does the accounting rule make them look like they're bleeding to death?
Okay, imagine you buy a house for $1 million, and for 1 week the market dips, and your house is appraised at $800,000. Under the old accounting rules for digital assets, you have to report that $200,000 drop as a loss on your income statement,
Even if I didn't sell the house.
even if you didn't sell. And here's the kicker. If the price goes back to $1 million the next week, you cannot report that recovery as a gain until you actually sell.
So you catch all of the downside on the report.
And none of the upside.
That's silly.
So when you see that 4.87 billion JPY in loss, it's mostly just a reflection of Ethereum's price volatility. It's not cash leaving the bank.
That is a crucial distinction. The loss is a paper tiger. But let's talk about something that isn't on paper. It's on YouTube, the Beast Industries deal.
This is one of the most interesting moves I've seen in the sector.
This deal closed, what, January 19th? It's a $200 million equity stake in Mr. Beast's company. Now, I have to admit, when I first saw this, I rolled my eyes.
I'm sure a lot of people did.
I thought, okay, here we go. Crypto company trying to get cool points by buying into a YouTuber. It feels like a distraction. Why does a digital asset treasury need a YouTube channel?
Well, it's a distraction if you think of them as just a bank. But if you think of them as a network adoption vehicle, it's kind of brilliant.
Go on.
What's the biggest hurdle for crypto right now? It's not the tech. The tech works. It's adoption. Getting normal people to actually use this stuff.
Sure, onboarding is a total nightmare.
Exactly. Now, you look at Beast Industries. They have access to over 450 million subscribers. Bitmine isn't just buying a piece of a celebrity. They're buying a funnel.
A funnel for what?
For customer acquisition. If you're a DeFi protocol and you want 1 million new users, doing that through Google Ads costs a fortune. Your customer acquisition cost is sky high. But if you own a stake in the platform that commands the attention of 500 million digital natives.
You can just drop the product directly into the content.
Precisely. It's an arbitrage on attention. They want to drive DeFi products through that entertainment pipeline.
So they're not buying the videos, they're buying the eyeballs to sell financial products to.
It's the convergence of DeFi and the creator economy. And they're betting $200 million. This is the future of marketing.
Okay, that makes a lot more sense. So we have the treasury, the marketing funnel, and the infrastructure, because they do still have those immersion-cooled data centers in Trinidad and Texas.
Right, low-cost power. They haven't abandoned the physical layer. They've just built a financial skyscraper on top of it.
All right, let's pivot. We've talked about what the company is. Let's talk about how the market is treating it. Time for the technicals.
Let's pull up the chart.
If you're a momentum trader, Bitmine has been, well, let's call it character building. The volatility is nauseating. The 52-week range is from a low of $3.20 to a high of $161.
That is a 5,000% spread. It's just insane.
It is absolute whipsaw action. Right now, we're trading roughly between $25 and $32. So we're looking at an 80% drawdown from the highs.
A world of hurt if you bought the top.
Oh, yeah. But if you zoom in, the last 90 days have seen a 46% rebound.
Which suggests the bleeding might have finally stopped.
It looks that way. But here's the technical signal that I think is the most important number in this whole discussion. The Stark is trading at a price-to-book ratio of 1.0x.
That's the magic number.
Explain to everyone why 1.0x is so weird. I mean, usually tech companies trade at 10x, 20x, sometimes 50x their book value.
Right. Book value is essentially what the company's assets are worth if you liquidated it today. Sold all the ETH, sold the data centers, paid the debt.
So what's left over?
Exactly. And usually, investors pay a premium above that. They pay for future growth, for the management team, for the brand.
So if a company has $1 in assets, the stock might cost $5 or $10.
Right. But Bitmine is trading at 1.0x. That means for every dollar of stock you buy, you're getting exactly $1 of assets. The market is effectively pricing the entire operating business. The mining, the staking, the Beast deal, it's zero.
That is harsh. It's the market saying, we don't trust you to create any value, you're just a bag of coins.
Or that it expects the coins to drop in value. But for a value investor, buying assets at par and getting the business for free, that's usually a very strong signal.
It's the buying $1 for 50 cents logic, or in this case, $1 for $1 and you get a free lottery ticket. But what about the volume? Is anyone actually buying this thesis?
Volume is definitely elevated. We're seeing about 45 million shares changing hands daily.
That's high turnover.
It is. And typically when you see high volume after an 80% crash and the price starts to stabilize in a range like this, it signals capitulation.
The weak hands are finally out.
The retail investors who panicked sold at the bottom are gone. Now the shares are moving from weak hands to strong hands.
Strong hands usually means institutions. So let's pivot to sentiment. Is the smart money actually showing up here?
This is where the bull case gets its legs. We can actually see it in the filings. We've seen significant cluster buying.
So who's buying?
The biggest one is Sumitomo Mitsui Trust Group. They bought 3.7 million shares. That's an investment of about $196.5 million.
Nearly 200 million. That's not a trader taking a flyer. That's a board-level decision.
Huge conviction. And they're not alone. Robeco bought 140,000 shares. Commonwealth Equity Services, Madden Securities, they're all taking positions.
So multiple funds moving in at the same time.
Exactly. It's not a coincidence. It's a coordinated recognition of value. They're all looking at that discount to NAV we just talked about and saying, this is mispriced.
It definitely backs up the capitulation theory, and we should probably mention the regulatory landscape because that shifted in January too.
Yes, the MSCI decision on January 6th.
This sounds boring, MSCI index inclusion, but explain why this actually matters for the stock price.
It's all about passive flows of money. MSCI decided not to exclude digital asset treasury companies from their global indices.
Ah.
This means Bitmine is now eligible to be added to major stock indexes. If that happens, every ETF and mutual fund that tracks that index must buy the stock.
It creates a forced buyer.
The huge forced buyer. It opens the floodgates for billions in passive capital that has to own the index. That is a massive tailwind.
And speaking of tailwinds, we have Tom Lee from Fundstrat.
He's the chair of the whole sector, basically. He recently predicted that if Bitcoin hits $1 million, Ethereum could hit 250,000.
Which is, look, I love optimism, but that is a very, very aggressive target.
It's extreme. But even if he's half right or just 10% right, the implication for Bitmine is huge. They're a leveraged play on ETH.
Right. So what's the analyst consensus?
Overwhelmingly buy or strong buy. The average price target is sitting around $43 to $47.
So with the stock around 30, they're seeing 50% upside. Okay. We've been very positive. Let's put the skeptic hat back on. Let's pivot to the risks. Because you don't trade at an 80% discount without some serious skeletons in the closet.
Oh, there are definitely skeletons.
First up, concentration risk. That alchemy of 5% sounds great when ETH is going up. But Bitmine is basically a proxy for Ethereum, zero diversification.
That's undeniable. If the Ethereum network fails, or the price just drops 50%, Bitmine's treasury is halved instantly. And the stock will probably drop even harder.
It's a double-edged sword. But here's the risk that made me gasped when I read the shareholder notes from January 15th. This is the one that keeps me up at night.
The share authorization.
Yes. The shareholders voted to increase the number of authorized shares. Now, they had 500 million authorized.
Which is pretty standard.
Right. But they voted to increase that limit to 50 billion shares.
It's a staggering number.
50 billion with a B. That is a 100x increase in the amount of paper they can print. Why on earth would they need that?
It's a printing press.
Exactly. As a shareholder, I'm looking at that thinking, are you about to dilute me into oblivion? If they raise capital to buy more ETH when the stock price is low, my slice of the pie just vanishes.
That is the classic treasury trap. To grow the treasury, they issue shares. If they do it when the stock is at a premium, it's accretive, it adds value. But if they do it when the stock is weak, it destroys shareholder value.
And with 50 billion shares in the chamber, they could dilute existing holders to zero if they're not disciplined.
And that discipline is a big question mark, especially since we just saw a management shakeup.
Right. The president, Eric Nilsson, was terminated without cause.
Without cause is corporate speak for we didn't get along, not something illegal.
But still, when you're managing $14 billion, you want boring, stable management. Sudden firings make the market nervous.
It signals internal friction. So we have the bull case of the massive undervalued treasury and the bear case of extreme risk and potential dilution.
Yeah.
So how do we score this? What's the verdict? You know, when I look at the balance of risk and reward, I lean towards the bullish side. And it comes down to one specific catalyst that's launching in Q1 2026.
That would be Mayan.
Mayan.
Yeah.
The Made in America Validator Network.
Okay. Explain why this is the game changer. Why does this matter more than the Beast deal?
Because it solves the cash flow problem. Right now, Bitmine holding all that ETH is like you holding gold bars in a safe. It just sits there. You hope it appreciates, but it doesn't pay you anything.
Right. It's a dead asset.
Mayan is their staking solution. In Ethereum, you can stake your coins to help secure the network, and the network pays you a yield. It's like a dividend. Bitmine is about to turn that stagnant pile of 4 million ETH into a working productive asset.
So they flip a switch and suddenly they're earning. What's the yield?
Typically 3 to 4% annually. On $14 billion of assets, we are talking about the potential for over $100 million in annual recurring revenue.
Wow.
And it's paid in ETH, so it compounds.
That completely changes the fundamental picture. Suddenly, you're not just a holding company burning cash, you're a cash flow positive fintech company.
Exactly. That yield covers their operational costs, it funds their expansion, and crucially, it reduces the need to use that terrifying 50 billion share authorization.
It makes them self-sustaining. So, based on the research score and the consensus, what's your final number?
I'm giving this a bullish score of 8 to 9 out of 10.
That is incredibly high, given the risks we just laid out.
It is high, but it's based on the asymmetry. You're buying 14 billion of assets for an 11 billion market cap. So you're getting the assets at a discount. You have a strong buy consensus. And you have Mayan coming online within weeks to turn on the cash hose.
So the thesis is, the market has overcorrected to the downside. The fear is greater than the reality.
Exactly. The trade here is a multi-quarter hold. You're targeting that 43 thriller plus level. You wait for the Mayan revenue to hit the books, prove to the market they can generate cash, and watch the gap between the stock price and the net asset value close.
It's a compelling argument. You get the crypto exposure at a discount, with the potential yield kicker coming soon, and you're standing with some massive institutional buyers.
That's the bet.
Well, there you have it. A deep look into the alchemy of 5%. It is risky, it involves a 50 billion share printing press, but the math is certainly interesting. That's it for our look at Bitmine. Don't forget to subscribe, like, and comment to support the show. We'll see you next time.
Thanks for listening.